Welcome, everyone. Welcome to this week's edition of Crashes and Taxes. I'm getting a new microphone, so just bear with me with this one for this week, and then we'll get the new one next week. I know we need a better microphone. So the producer and I are working on that. Thank you for all of our new subscribers and new listeners. If you like the podcast, please give us a thumbs up, a rating, whatever it is. And also, please refer us out to your friends and family. It does take a lot of work to put this together, especially today, this one. And so it is, let's get the information out there. There is a lot to go over in this podcast, so I'm going to try to keep it to an hour or less. But if you are ready for a deep dive into what is going on in this world, this is probably going to be I hope I'm going to attempt to make this one of the best summaries that you've ever gotten that you've ever heard. So this is what I'm attempting to do today, is to really get the lay person to understand what is going on and what does it mean for you in your own and individual life. Okay, there is a lot to cover, a lot of slides, but I just want to give you some upfront information as we start this podcast. First thing I want to talk to you about is the insurability of your deposits at FDIC banks. We'll talk about credit unions later, but FDIC, Federal Deposit Insurance Corporation. Now, the government came out last week, and basically Biden came out Monday morning before markets even opened and said that all of the SVB depositors, try to talk fast, depositors would be made whole. Not that they would be restored to FDIC limits, but they would be made whole, which is completely unusual, outside the scope. So that got me to do some investigation into how much of our deposits are actually insured right now in the U.S. banking system as a whole, as in general. So this is Bloomberg reporting that as of now, just under half, 47.8% of deposits at FDIC insured U.S. financial institutions. So that does not include credit unions. That does not include anybody that is not insured by FDIC insurance. So these are just traditional banks. Just 47.8% of those are uninsured. Now, what does that mean? You think, well, that means everybody's pretty much 53% almost, or 52%, Rebecca, is insured. That's not what that means. What that means is that of all the balances in the United States at FDIC insurance banks, FDIC insured banks, that only 52% is covered by that 250 limit. And that means that all of the rest, 48%, is not covered. So we have 48% of all deposits in the U.S. banking system that is subject to FDIC insurance, not covered by FDIC insurance. So in other words, 48% of our entire banking system is not insured. And if the banks were to fail, those deposits would be lost to the depositor. Remember that you are a liability to your bank. You deposit your money. It's your asset. But the second that you give over legal custody to the bank, becomes the bank's asset. That's your agreement. And you become a liability for that bank. They owe you back that money. So you are their creditor. They have a liability to you. If that liability for any reason should fail, the United States government would come in up to the 250 and insure about 52% of all of those deposits. The rest, 48%, nearly half of our bank deposits, would be lost. Now, for those of you that think that the government can come out and do what Joe Biden did, a week ago, this past Monday, and say that they will insure and make everything whole, that is not physically possible. We will become immediately Zimbabwe, Venezuela, German marks, when they literally, at the time of the collapse in Germany, the financial collapse in Germany, you had basically one German mark equal, used to have 4 marks to $1. And when they collapsed, the financial collapse that they had because of all the reparations they were paying from World War I, it took and I'm not kidding, this is the true number. It took 4.2 trillion marks to equal $1. That's how bad their economy was failing. So do not think that the United States government is solvent enough to come in to fix this problem for everybody. It is not. In fact, we are completely insolvent. And I'm going to walk you through today how this is a designed thing, not initially, but as we continue down the road of quantitative easing. And if you don't know what quantitative easing is, that's where the Federal Reserve printed money out of thin air. We basically borrowed it from the Federal Reserve as a country, and we just injected it into our system to make our system continue and not completely collapse. And when we decided to do that, really this Keynesian economic theory of modern monetary theory that you can basically just keep printing for indefinitely, and as long as you can collect enough taxes to pay your service, your debt, you're fine. This Keynesian economic theory, the second that we really adopted it, I would say early 2000s .com crash was the beginning of it. But certainly, I mean, you can go back in our history. We've had periods of time where the government has definitely reinforced and backstopped us. And of course, we've changed financial systems. 1944 Bretton Woods, New Hampshire, for example, establishing the dollar as the global currency reserve, tied and pegged to $35 an ounce for gold. All of those things are market manipulation type tactics that are necessary to have some kind of global financial system. But where are we now in March of 2023 on the scope of that? That is what I'm going to attempt to answer for you today. So you can have a very, 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 very good understanding, way more than the average American, of what is going on. But for anybody that is listening to the United States government, the Federal Reserve, you need to understand where, with the position that they are in. They have to, and they will now at this point, because this is the worst it has ever been or ever will be because of what's about to happen. They will do everything. They will say everything. They will show everything. They will do anything and everything they can to prevent what is going to happen, or at least they're going to appear that they're doing anything and everything they can to prevent what we are on the precipice of actually happening. And so they will fool many millions of people into thinking that everything has been solidified and backstopped and it is safe and that you should stay status quo and stay the course. And unfortunately, all of those millions of people that do stay status quo and stay the course are going to live to regret it. They're going to live to regret that they were too busy and their Facebook and their TikTok and their social media and, Twitter and LinkedIn and their job and their family and their career. And they're going to be so distraught that they did not stop what they were doing, get outside of their box, break it down so they could understand what is going on, that this is something that is different and it has never happened before. It's totally unprecedented. They're going to be upset that they continue to believe their government and all of the government actors as long as they did, and that they remained in the status quo, because it's the status quo people that will be left behind as this happens. If you think that the globalists that understand finance are going to be left behind, sorry, that's not where we're heading. So with that kind of highest level thing, I want to also give you just kind of a stat right here about check to check. If you look in April of 2021, and this is when we had the last round of COVID stimulus distribution. So this is why specifically I looked up April 2021. If you look at April 2021, we had 52% of Americans living check to check, paycheck to paycheck. And we were still in the midst of coronavirus impact, and we were getting a lot of government stimulus. If you look now, the most recent survey that just came out, and this is from Lending Club that just came out, 2/3, 65% basically of the US consumer is now living check to check. What this means is 65% of our population, if anything goes wrong, if there's any kind of crash flow interruption, disruption, they are going to be the ones to immediately have severe financial pressure and problems. So we have to understand where everybody is right now in this mix. Let's go ahead and get started with our slides because there is just so much. Okay, so this was the World Government Summit. This is just in February of this past month. And I wanted to bring up that they are talking about the shock that is needed for a new world order transformation. So I am going to start with this as a slide, and I'm going to end with this, and I'm going to fill in between a bunch of data to explain to you what is happening and where we are headed. So I want you to understand that the world leaders are absolutely in the process of not only discussing, but implementing a new transition to an ultimate global system. And I will establish that with documentation and proof throughout this podcast. But this is really what we're talking about. We're talking about we are at the beginning of the end. So let me explain that again. We are at the beginning of the end of the current global fiat currency system. If you're a purveyor of this podcast, you have definitely heard this before. We are at the end of the global fiat debt system. Fiat meaning that there is no true hard asset backing currency, that it's just backed by a debt system, which is basically loan guarantees from governments, government insured, if you will, money. Now, not commodity or hard asset insured money, but government promise insured money. Now, that's why I just told you that 48% of all of the deposits in FDIC banks are not covered by that $250,000 limit. So half of our system is not covered by that limit. Now, obviously, credit unions are different. We'll get to those later, but I'm just talking about FDIC banks right now. So let's keep going. This is from a little bit ago. This was from, looks like March the 12th. So it's actually worse than this now, but I just wanted to bring this up that, why do our banks have such massive unrealized losses? And it's very simple. When banks go out into the world and they buy treasuries, they make investments, they get short-term overnight loans, all of these things they do to earn interest over what they're paying on deposits. They buy treasuries, they buy bonds, they buy US debt. And as the last 8 hikes, we had 7 hikes in 2022 and we had a hike in January, as the last 8 hikes have basically made the previous debt that was issued at lower interest rates, not worthless, but worth less than it previously was when it's bought. And the amount of that loss for all US banks, FDIC banks, is $620 billion. And it's larger than that. But let's go on with CNN's number. Now, this also was from the same time frame. I think basically, let's see, March the 9th. So again, this is a little bit dated because of the fact that it's the third week of March now. But at the time when the banking, when basically we started looking at these market losses, the 4 largest banks themselves alone had 47 billion. That's Citi, Chase, Wells, and Bank of America. So those are those 4. And I just wanted to point out that again so you guys could see that. All right. So now let's talk about what the Fed is doing, what they have done. They obviously have another FOMC meeting today. I'm recording this on Wednesday prior to the Fed announcing. And everyone now in the market is somewhat expecting that the Fed might shift or pause. I do not see that happening, and I will tell you why in just a moment. But later today, it will get announced. I'm expecting a 25 basis point hike, and I will explain why. But here's an announcement on March the 12th from the Federal Reserve, where they announced they're going to make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of their depositors. So in other words, they're coming out and they're saying, we are going to backstop this system. What did I say at the very beginning? Every member of the Fed, of federal government, of central banks throughout the Western SWIFT-based monetary system and monetary transfer, global transfer payment system will do and say everything they need to say right now to prevent the system from its ultimate demise, which is where we will see the demise of this system. I expect that it will be in 2023 based on how fast everything is moving. However, it's very possible they could continue their delay tactics by backstopping things, and it could give us a reprieve of 12 to 18 months. I expect a 2023 transition. This goes with, and this is what no one ever talks about. All of these market-based people, these analysts, they all talk about Agenda 2030 with the World Economic Forum, but nobody talks about the fact that it was publicly announced in March 9th of 2022 that the World Economic Forum and the United Nations signed an MOU, a Memorandum of Understanding, that stated that two organizations, the United Nations quasi-government organization, obviously participated with all the governments of the world that are members. Not everyone's a member. And then the World Economic Forum is an NGO that basically tries to come up with globalist policies to help Fortune 100 and world leaders, central bankers control the direction of the world. So these two groups, the United Nations and the World Economic Forum, signed a Memorandum of Understanding, MOU, on March the 9th of 2022, advancing the date of the implementation of Agenda 2030 from 2030 to this year, 2023. So understand that when we talk of Agenda 2030, we're really talking now of Agenda 2023 because they have advanced it. So I'm expecting a demise of the system forthwith, 2023. But because of all of the backstops they will lay out, and I will show them to you here, we could see another 12 to 18 months. I hope not, because I am helping people manage their financial worlds. And I don't want to slog through this for 12 to 18 more months and continue to convince people that, what I'm saying is not only going to happen, but it is impossible now, mathematically impossible now that it does not happen. So it's a mathematical certainty in my analytical mind. It is a mathematical certainty. There's a scene in Titanic when I think it's one of the most important engineering, analytical, mathematical scenes in probably cinematic history, because it's a scene where the engineer goes and gets the blueprints of the ship, and he goes to meet with the captain after everyone's aware that they have hit the iceberg, and he rolls out the blueprints of the Titanic, and he explains to the captain the bulkhead system. And he said, she, meaning the ship, they called ship she, obviously, he said she can withstand 4 bulkheads being breached. But the moment the 5th bulkhead is breached, she will sink. It is a mathematical certainty. Now, I cannot tell you with that same level of mathematical certainty that this fiat system will collapse in 2023. But I can tell you with absolute mathematical certainty that the debt fiat system will collapse. It is mathematically guaranteed. And that is a simple function. And to break it down at the most basic level I can, so everyone can understand, even if you don't understand finance at all. If you have a system globally where the money supply system, the monetary system, has no tethering to true hard asset values, and it can just be derivatively invoked again and again and again, and it can get so disconnected from the true organic value of hard assets globally, worldwide, then you have a system that will fail. It is an economic certainty. The only question is when and how fast and how badly and how much of an impact is it? So that is what we have gotten to. It has taken 200 years, certainly since 1944. And I go back before that to 1913, when in the United States, the Federal Reserve was created. So we are going to see the end of this system. The only question is when, is the timing. And so because it could happen literally tomorrow, I am doing everything I can to be as public as I can about what I understand and what I know to be true. It's obviously, I try as the lawyer in me to back up everything I say with hard documentation so that you guys can see it with your own eyes and you can understand it with your own minds. But there is no delusions in my world that the current system will continue beyond 18 months. And again, it could happen much faster. So you have to understand what happened in 2008 when they shut down the banking system and they froze all access. They basically said that by, like 10 and 11 a.m. in the morning, they already had 550 billion of money market deposits withdrawn. This is 2008, Lehman Brothers collapse, Bear Stearns, Merrill Lynch. This was that time frame. And by 11 a.m. in the morning, 550 billion had already been withdrawn electronically from the money market system. By 2 o'clock in the afternoon, it was getting to basically would have been around 2 trillion. By 4 o'clock in the afternoon, had they not shut the system down, they expected that $5 trillion would have been pulled out of the US banking system. And that would have been something that would have never been able to be recovered from economically. So that's why it could happen tomorrow. Because if the American public really understands what is happening, if everyone in America watched this podcast to the end and understood what's happening, they would take their money out of the banking system immediately, even if they had to have it in a like mobile safe, with them. They would take their money out of the banking system. We would have bank runs. The system would collapse and it would never recover. So they have to do everything now to make everything seem totally, copacetic. Everything's fine, to delay the inevitable, but it is actually mathematically inevitable. So we have this exchange stabilization. My goodness, we have this exchange stabilization fund. This was part of the Gold Reserve Act of 1934, and basically, it was really to stabilize exchange rate monetary manipulations between the U.S. dollar, foreign currencies. So, like for example, I talked about the Swiss National Bank, which just backstopped Credit Suisse to the tune of $54 billion before UBS bought them this past week. But they had lost, the Swiss National Bank, they lost $143 billion in 2022, their largest ever in their 116-year history, because of the strength of the US dollar last year compared to their domestic currency, which obviously that was because we had 7 rate hikes. But this exchange stabilization fund has been around. It's really geared more towards the international exchange. It has obviously foreign currencies, certainly has euros, certainly has dollars, but it also has IMF, the International Monetary Fund's SDRs, special drawing rights. The International Monetary Fund's special drawing rights is really a commodity-based currency of 5 currencies. So it is the US dollar, the British pound sterling, the European euro, the Chinese yuan, and the Japanese yen. And so we have also SDRs inside of our exchange stabilization fund. And so you can see that we have the Federal Reserve talking about possibly backstopping the banking system to the tune of $2 trillion. This is not enough. But to put this in perspective, the Swiss National Bank backed up Credit Suisse 54 billion. So 2 of those would be roughly 100 billion. That's 2 Credit Suisses to get to 100 billion. 10 of those 100 billion sets would equal 1 trillion. So that's 20 Credit Suisses to get to $1 trillion. And then if you have 2 trillion, you have the size of 40 Credit Suisses needing to be backstopped in order to not have the banking system fail. It's actually not enough. The $2 trillion might back up just the regional banks alone, we would have to have another 1 to 2 trillion to back up our SIBs, but our global SIBs. SIBs is the new term that is being used now. In 2008, 2009 crisis, it was too big to fail. They can't use too big to fail anymore. Everyone would be like, why didn't you learn from the last crisis? So now they have changed it to SIB, systemically important bank. Basically, a systemic important. In other words, if this bank fails, it will be a catalyst, a domino, a snowball effect onto other banks. And that's how SVB was basically made backstopped whole, not to the 250 FDIC limit, but they were backstopped because they were a regional bank that was a venture capitalist bank that was determined to be, systemically important. And so a SIB, and so it's a regional bank, but it was fully backstopped. So Janet Yellen then went to Congress last week and testified in front of Congress, and she got into one exchange with a Republican lawmaker, and basically she admitted that that the regional banks weren't necessarily systemically important, and because of that, they didn't necessarily see that they would treat those depositors as fully protected. That made the regional banks come out and say, no, Federal Reserve, you need to backstop all banks for 2 years. Again, as I mentioned to you at the very beginning, we have 48% of all FDIC insured banks that those deposits are not insured. They are over the insurance limit of the 250. They're not insured. And you have to also look at how much the Fed actually and the FDIC insurance fund actually has. It's woefully and hopefully inadequate. It would not be adequate enough. But we're talking about literally to fully backstop the banking system anywhere, and this is the regional and the nationals, the globally systemic and important banks are the global SIBs. The total backstop would be anywhere from 3 to 4 trillion dollars. Now, you have to understand the Federal Reserve is in the absolute last position to be the solver of this problem, because the Federal Reserve has over $8 trillion of bonds and U.S. debt on its books right now from coronavirus and all the stimulus that we leveraged through the coronavirus situation. So that has led Powell, this was announced on Monday, that has led Powell and the Fed to sort of panic. That's what this Zero Hedge article says from Monday, March 20. Fed panics, announces coordinated daily U.S. dollar swap lines to ease banking crisis. Now, I need you to understand, this is not just a U.S. operation. This is, in fact, an international coordinated daily swap operation. This is a small little tweet, but I grabbed it because I loved it. This was basically just tweeted on March the 19th. And you can see we've got the Bank of Canada, the Bank of England, the Bank of Japan, the ECB, the European Central Bank, the Federal Reserve, and the Swiss National Bank. That's 6 central banks, and obviously the Federal Reserve being the largest. Since 6 central banks have announced a joint liquidity operation. This is the threat and the risk of a global financial system. If your global financial system is so intertwined amongst the countries, then when one country is failing, it is going to have a contagion effect on the other countries. So this is a 6 central bank coordinated joint liquidity operation. As you can see, this is there's more than 80 trillion. This is an additional tweet here. There's more than 80 trillion in hidden debt that is held by shadow banks and non-U.S. banks. So, the 650 billion in bonds and loans in distressed territory, and we have unregulated stable coins, tens of billions. Anyways, the bottom line is, as I've been speaking of, liquidity is going to be the ultimate final nail in the coffin of the debt fiat system. It is 100% liquidity. And here is just the proof that the Fed is panicking and coordinating now with with 5 other central banks. I just wanted to kind of bring this up again. This is from the second week of March, but I just need you to understand that the institutions are not usually the ones that are facing the losses. It's usually the retail investors. That's you, that's me, that's our bank accounts, because the institutional money that really runs the world, they know what's happening. They're talking to each other. They're talking to the central bankers. The head of Fortune 100s, they're talking to the central bankers. They're talking to the governments. They understand. They're talking to the Bank of International Settlements. They are talking to each other. They know what's happening, and they're protecting themselves. We had 2 of the largest Israeli banks get out $1 billion out of SVB before the collapse. Literally right before the bank was seized by the Federal Reserve. So I need you to understand that if you think they're coming out on the television to tell you that everything is fine, so because they want the institutions to feel like everything's fine, it's not about the institutions. It is about the psychology right now of the American consumer consuming banking products and banking accounts and trying to make them not go to their bank and withdraw their money, because the system we have is designed to be insolvent. When you have a fractional reserve system, what that means is I make a deposit and not the entire deposit sits in the bank. No, the bank uses that money as their money, loans it out, does their credit underwriting review, all of those due diligence things that they do. That's what they do. But then they're making money on that money that you're not currently using. If everyone is to go and pull their money out, the banking system collapses in less than one day. As I already mentioned to you, what happened in 2008, the banking system had to be shut down. And then you had the federal government come out and say everything is going to be insured up to the 250, and people calm down. People are not calming down this time. People are seeing that Janet Yellen testified before Congress last week, stating that the regional banks would not be bailed out and that they're going to be subject to those limits. And so now you have people in America leaving regional banks and moving to the global big banks, our 4 biggest I already mentioned, which is exactly the opposite of what you should be doing. Because, if you think that 4 large banks can handle 20 to 50 million American clients and deposit accounts all at the same time, they don't have enough staff to handle Americans going to 4 banks. It's just an impossibility. It is a system that is designed to collapse. We just had a new global fund manager survey come out from Bank of America, basically showing investors are very bearish, and they're really bearish at record levels in the last 2 decades. The biggest thing that was flagged was, what did you know? A systemic credit event. That is our largest economic risk. So this is known. The institutionals and the people that run the world's money supply know. This was a credit union that we pulled. We saw this and we pulled it for you guys. It's just interesting. This was March 17. This is what a credit union basically sent out to their members. Dear credit union members, the recent failure of Silicon Valley Bank has been all over the news and no doubt raised questions in people's minds about the safety of their funds. As a not-for-profit cooperative co-op, credit union's first priority is that of our members. As a credit union, we do not have outside stockholders, large investors to answer to. Rather, we are owned by you, our members. This is consortium of ownership, just like, a mutual fund or something like that. Let me reassure you that your deposits at such and such credit union, linked out, are safe, secured, and insured up to $250 per individual depositor by the National Credit Union Administration, NCUA, the same level as any federally insured financial institution. Visit mycreditunion.gov for more information about the National Credit Union Share Insurance Fund coverage for consumers. Our industry is in very good shape and very well capitalized during the 2008 financial crisis. Credit unions did not cost the taxpayers any money, and we took no bailout money from the government. That's phenomenal. That's phenomenal. When you had such big bailouts by large banking systems with the TARP, the Troubled Asset Relief Program, and those kinds of things, credit unions were not a part of that. Credit union members have never lost a penny of insured savings at an insured credit union. The recent bank failures are a result of mismanagement and high levels of concentration in certain risky assets, i.e. derivatives. The high current interest rate environment ultimately exposes those banks to losses. In other words, rates went up too fast, values on existing assets that were being held went down too fast, and people started to have to live off cash flow, so they started draining their bank accounts. And that is, when you have a liquidity drying up, this is where you're going to have massive problems. All right, I want to go now to some charts, and these are really just so insightful. This first one is the overnight reverse repurchase agreement. So what's happening is the Federal Reserve is actually competing against banks right now because it's in the money market business. It's basically getting overnight deposits, and it's paying, it's got a haircut what it's paying, but it's basically paying right now as of yesterday, 4.55 overnight on deposits less the haircut to the actual bank. So they are competing with regional banks and all of these banking institutions for their CDs and their accounts. The Federal Reserve offering such a large overnight return is going to draw money out of the system even further. And that's what you can see here, is that you can see that since rates have gone up, really, that the amount of repurchases that the Fed is competing against the banks themselves. So that's one of the problems that we're having. But here's the money supply. And the money supply has actually contracted this year. In other words, we have less dollars floating in the system. We have a contraction of the overall money supply. So what does that mean? Where are these dollars going? If they're no longer we're not talking about, the fact that the deposits have shrunk. We're talking about that the money supply itself has actually gone down and shrunk. Where are these dollars? They're not being held in banks. They're not in companies where they've been spent. Where the money supply is contracting, which is highly unusual, especially given all of the things that are happening right now with liquidity and the Fed backstopping. So the Federal Reserve has already started. We've already started to see the Federal Reserve. I didn't grab this chart, but I should have. We've already started to see that the Federal Reserve's balance sheet has increased by $300 billion in the last 10 days. They are already, without announcing it, they're already backstopping and basically banks again. They have already started to put money and backstops in place so that their balance sheet is already growing, even though it hasn't been technically announced. And this really is showing you the lending standards for commercial credit and how they are tightening. This is the tightening. You can see that as the standards tighten, that's where the chart and the graph goes up. You can see recessionary times. So if you look at 2008, 2009, this gray shadow here, you can see that when 2008 began, the lending requirements, the lending underwriting requirements shot straight up because they could no longer take any really unnecessary risk with loans. And that happened again in 2020, right at the very beginning. It dropped immediately once we realized that the entire world was going to just print money. So then the standards went back down to very non-tight. But now you can see with the beginning of 2023 and the end of 2022, as soon as because the Fed was still quantitative easing in 2021. They used the term inflation is transitory and they continued business as usual, which is why we didn't see a tightening in 2021. In fact, it was very loose in 2021. The second that 2022 came, we started raising rates, cutting quantitative easing. The lending requirements went straight up. And this should tell you something about moral hazard. If this just shows you very clearly that if banks think that the Federal Reserve will backstop their lending decisions, they will make bad ones. The second that they realize they're on their own and they could be left holding their own bag, their underwriting and lending requirements go up immensely. So this is extremely interesting and it's a big tell. All right. Let's start to now put the bigger picture together of everything that we've been talking about and sort of understand where we are in this global picture. So this is from March 20 out of The Street. Elon Musk warns the banking crisis may lead to something bigger. And the crisis of confidence affecting regional banks poses serious risk to the economy, the billionaire entrepreneur warns. This is really what is happening. This is really the truth of where we are in the global financial system. And I just loved Elon's little Musk, his little high level, statement about it. Russia, this is from Business Insider on March 17th. And here you're going to start to see now the bifurcation that is already happened. And I've been talking about it. But the West and the SWIFT system is being pulled away from. So here's the system, and it used to be everybody in the system, right? Over the last 20 years, there is a consortium of countries, all different kinds, that have been pulling away from the West, the SWIFT, and Russia's invasion into Ukraine February last year, their subsequent cutting out of the SWIFT system really quickly thereafter last year has really now showed us that the ability to compete globally it's here. Like, we no longer can control the BRICS nations with our economic sanctions in the SWIFT system. So they have now, without it being publicly announced and in a paper that I can show you, they have successfully navigated, recauterized different economic channels that simply bypassed the West. We have been left behind. The West has been left behind. And they've done it so stealthily and so quietly, although China announces everything they do, and you just have to know what you're looking for. Not everything they do. They have a lot of secrets, obviously. But the things they want you to know, they announce. They have done it so stealthily and so quietly that it's, I believe, going to be the revelation to people that this has occurred that will, in fact, be the end of the system as we know it. People will finally realize the system is collapsed and it is over. And that's because the United States and the West, the system of currency and economy cannot survive without without China. I mean, we are an economy that is substantially and severely, to our own demise, dependent on Chinese imports. And when they have the ability to just, a lot of people make the economic argument, well, they'll always need the United States to buy. And they just don't understand what China has done over the last 25, probably 30 years. They don't get it. But this is a great synopsis that is telling us exactly what I'm telling you, that these countries, this alignment, BRICS, I'll say, if you will, have so engineered and restructured their economic means that really let's just read this. Russia is so cut off from the international financial system, and that is the system of the West, SWIFT system, that the Kremlin thinks Western sanctions have insured the country against the banking crisis. In other words, Russia's saying, while you guys were busy stimulating, creating, keeping your bubble going from 2008, 2009, when you could have let it collapse then, you backstopped it, you reinforced it, you went crazy, you went straight MMT, and you've done that now all the way up into 2020, when then we had coronavirus and we shut the whole world down. And then the global central banks basically decided, let's stimulate through all this. Let's stimulate. So they did stimulate through all this. And now we're at the final reconciliation of this system that is on fumes, and we can't do anything because we've backed ourselves into a corner because we backstopped the global pandemic. So we have sustained now such a massive debt burden getting us through coronavirus that we don't have the ability for the Federal Reserve to bail us out this time. They can't add another $4 trillion onto an $8+ trillion already balance sheet, when their intention for 2023 was not only to continue to raise the cost of capital, but was to also quantitative tighten and sell off their balance sheet. They're out there selling and competing up to the 90 billion mark a month. Obviously, that's not happening right now because of everything that's happening. But what I'm trying to show you is that Russia's basically saying your system's collapsing and we're so independent now of that system that we're not going to be a part of that collapse. And neither are any of the other countries that have seen this coming and have prepared alternative economic channels to circumvent and navigate around the crisis economically of the West. This is what has happened. They have, and this is an announcement of multipolarity, that they have a new system that bypasses the West and our demise and our collapse. And this is what I've been saying to you for the last 18 months, at least the last 12 months, at least since February of last year, that we are watching before our eyes the demise of the sole we are witnessing the demise of the singular global economic superpower, the United States, in favor of a multipolarity shared global superpower system economically. And it is going to be shared between the West and the BRICS nations. You could call it the East, but obviously the geographics aren't exactly all East. China, and this is from the BIS. This is the top central bank. This is the central bank of all central bankers, the Bank of International Settlements. And here is a white paper from October of 2022 talking about the digital channel bridge that the BRICS nations have created. This is really Bank of China and UAE, United Arab Emirates, that have put together, as well as Hong Kong. They have put together the Hong Kong Monetary Authority, Bank of Thailand, and this is introduction of CBDCs through digital channels connected in a distributed blockchain format on something called mBridge. So what they've done with mBridge combined with their Belt and Road kind of infrastructure, you've got about 80% of the world's population that is moving towards currency transactions this way with this digital Chinese yuan. And this is the beginning of the system. We also have the Shanghai Development Corporation. We have a lot of other things that China has done, obviously, with the BRICS nations, Brazil, Russia, India, China, South Africa. We have Mexico talking now about joining BRICS. We have Saudi Arabia, who's all but announced they are joining the BRICS nations. They have, let's just add up what Saudi Arabia has announced. They announced after we left Afghanistan in April of 2021 that they signed basically a new security agreement with Russia in 2021 post Afghanistan withdrawal. So basically the security agreement that backstopped the petrodollar, in other words, Henry Kissinger, who was the Secretary of State for Richard Nixon in February of 1974, went to meet with the King of Saudi Arabia and work out a petrodollar arrangement that basically the United States, Saudi Arabia didn't need to waste its money on military and nuclear weapons development and all of these things. They didn't need to worry about because they want the United States would be their basically military if they agreed that OPEC plus, and OPEC plus is the OPEC nations plus Russia, agreed to only sell crude in US dollar. And that agreement was inked, and that was the birth of the petrodollar. So the very first circumstance when we left Afghanistan and Russia took the United States' place as the security arbiter and protector of Saudi Arabia, that was their very beginning of the threat of the stability of the petrodollar. You then fast forward to 2022, and they announced last year at the end of the year that China was their number one economic partner. So you can see this consortium coming together of Saudi Arabia using Russia for their military protection and China as their number one economic partner. And you would just not be rational if you continued to state that Saudi Arabia and the United States are going to be long-term economic partners. Saudi Arabia has basically told us that is not true. They told us that directly in December of 2022. And then in January of 2023 at the Davos World Economic Forum in Switzerland, they announced that they are ready and they are willing to transact the sale of crude outside of the US dollar, which would be the end of the petrodollar. And all of this basically cascades into the end of dollar hegemony, the dollar domination of the global economic unit of transfer is over. That is where we are. The dollar has not yet collapsed, as it will when Saudi Arabia starts to transact outside of the US dollar. They have not executed what they announced in January. But the second that they go ahead and let countries start buying crude outside, and this is OPEC, Russia has already been doing this. Russia, which was OPEC plus, Russia said last year, we will not sell crude outside of in US dollars. It will only be in Russian rubles or gold. So they had already done that, and they've since expanded it back. But it's definitely they were the first after the entire kicking them out of the SWIFT system. Again, all of these things have been layered and cascading on top of each other. And so even though Saudi Arabia has announced it, they haven't actually executed yet. And that is probably the thing that we're waiting on for the collapse of the US dollar, because that will trigger when Saudi Arabia begins to sell crude outside of US dollars. If they start to accept the euro, if they start to accept the real, if they start to accept domestic, whatever they do, what's going to happen by that action is that a bunch of countries around the world that are holding dollars, that buy dollars so they can buy crude, will dump their dollars, because the dollar has been so strong because of these 8 rate increases we've had since 2022. The dollar has been so strong. I used the example of the Swiss National Bank at the beginning of this podcast, where I said they lost $143 billion in exchange rates to a strong US dollar in 2022. It was their most ever in their almost 120-year history. So banks and the entirety of the world doesn't like the dollar right now because it is so strong, and a lot of their liabilities are denominated in dollars, especially the IMF loans. But their assets are denominated in their domestic currency. So if you have dollars going up and your domestic currency going down, your liabilities are going up, your asset values are going down. You have to stop the bleeding. And the second that you can dump the dollar, because Saudi Arabia no longer requires it to be used to buy your crude, you're going to dump your dollar. It's the dumping of the dollars when Saudi triggers the crude sales outside of US dollar, the end of the petrodollar, that is in fact the probably singular event that would create immediate economic collapse for the US dollar. And as the dollar collapses, we're looking at a hyperinflationary situation because they're just not worth as much. And so if you consider that's where we are right now, before you even think about another 3 to 4 trillion to backstop US banking system, before you even think about this consortium of all of these central banks together, 6 central banks together, saying, hey, we're going to backstop each other. Like, who do we think we are? We can't keep this gravy train going. It's over. It's the end. And it is only going to take one event, whether it is a World War III escalation. We have Xi and meeting with Putin right now. I mean, to me, that picture of Xi and Putin standing side by side is it's alarming. It's an extremely alarming photo, because she basically said, this Ukraine situation's got to end. I'm going to come over here and broker this peace deal between Russia and Ukraine and get this done. And of course, in America, we're trying to fight a proxy war through NATO against Russia, who's now being joined by China. Now, I don't know about you, but like, to me, 2 global superpowers that have nuclear weapon arsenals that rival the United States is not something that we can be arrogant enough to think that we could overcome and overpower. We've lost before this war has even started. And when I say war, I'm talking about World War III here. We would lose. And that's not to say I don't love our military and I don't love our people. We have just become too arrogant and not fixed it. And now this is where we are. And the thing that is interesting about central bank policy and wars is that they always use war to obfuscate financial collapse. This is the playbook. You don't want the world to know that you've collapsed the system by overprinting money and not having it tethered to true hard assets, and that you've basically just overinflated the entire financial system so much that you have now guaranteed a horrible, hurtful collapse. You can't admit that. So you actually think you're going to come in at the end and print more money to fix the problem of having printed too much money. This is the ultimate arrogance of any society. It reminds me of Rome, who self-imploded upon themselves. They created their own economic collapse and demise, and that is exactly what we've done. I did a radio show like 9 years ago saying, we are Rome. We are going to become Rome. At the time, I didn't think it was going to come within 10 years, but it has. Here's another example. This is a blockchain for business page, website, and it's a resource, and it's how Enbridge cross-border CBDC encourages foreign digital yuan use. This is from November of last year, you guys. This is happening. So I will just summarize. Nope, I don't want to summarize yet. I do want to play something else for you that I do want you to see. Let me go to that. I think I know how to do this now. They've trained me on how to do it. So hopefully this works for you guys. This is Christine Lagarde, who's the ECB president.
We have been operating as a monetary anchor in relation to the commercial banks and the private money. If we are not in that game, if we are not involved in experimenting, in innovating in terms of digital central bank money, we risk losing the role of anchor that we have played for many, many decades. And we have historical examples of period where the central bank monetary anchor was not there, and that precipitated crisis after crisis. That certainly was the case at the time of the free banking in the 19th century. Do we want to go back to those days? Probably not. I would say certainly not from our vantage point, as a result of which we have to respond to the demand for those digital payments in order to maintain the role of anchor that we have been playing regularly.
So I think that clip basically shows you instantaneously that the central banking system, Christine Lagarde is the president of the ECB, European Central Bank, like the Federal Reserve, it's only for the European EU countries. Basically, she's admitting that if we allow decentralized finance to continue on, that central bankers will be irrelevant because they are not necessary, because the blockchain can be authenticated through a distributed ledger and verified through a distributed ledger, and there's no need for a central bank. So you can see that we are moving to a July launch of the digital dollar on FedNow, July of this year, because they want to not only compete, but they want to take it over. DeFi, they want it to be dead. You know that the United States is regulating on not only the banks that are crypto banks that support the conversion of crypto back to US dollars, so it can be back used in the system again. They are going after their crypto banks. They are going after all of decentralized finance. They're going after all of cryptocurrencies, everything except for really Bitcoin, which eventually would be probably attacked too. So the central banks know that they are at the precipice of not only losing the entire system, that they've ballooned up so much with so much debt. They've just over leveraged all of the assets of the earth and even human intellectual property. They have over leveraged and created such a debt bubble that is no longer sustainable, that it is on the precipice of bursting. And they also understand that because there is now decentralized finance, that they must not only control the system, they must take the system over, because otherwise they will relegate themselves to being irrelevant. This is something that they know, that they are publicly admitting, and this is the end of the system. Whether we have Saudi Arabia trigger the dumping of dollars by starting to execute crude sales outside of the US dollar, or we have the central bankers of the world trying to force us onto their domestic CBDCs, like that, what's happening in Nigeria, limiting the use of traditional cash and currency to 35 US dollars a day, forcing you onto the central bank digital Nigerian currency usage. However they decide to do it, they are going to pull out all the stops from here to the end to make this thing the way they want it, which is ultimate totalitarian control through an electronic payment voucher system that is not money, it is not currency, it is basically controlled by the central bank. This is where we are, you guys. And, it is going to be a very, very, very long and tough road ahead. There are things that can be done. If there weren't, I wouldn't bother. I'd be living in some small country where nobody knew who I was, and I would be in a bunker, and I would not be here with you telling you this is coming and that there are things that can be done. But there are things that can be done. You just cannot be naive enough to believe that the system is going to be backstopped one last time. It cannot be backstopped after coronavirus and the amount of stimulus and money that was printed. We cannot solve a problem of printing too much money by printing more money. So that is why the system will collapse, and they will force you on to the new central bank digital currency. So you do need to take steps to protect yourself. And on just another note, I will just quickly share with you that please go to my podcast that I did in February 23rd, unveiling the web of globalization and the totalitarian control of humanity. I've talked to you today 100% just about the economic system, but I need you to understand that they have done a lot of things in every area, in the area of law, in the area of just every area possible. They have engineered a situation where they now have the ultimate power over the human population. And this podcast was an hour and a half long, but it walks you through in the United States the loss of all of our freedom over our human body. The loss of the control of body autonomy. It has already happened in the United States. People are not aware of it as usual. And so please go to the podcast and watch this so that you can truly understand all of the ways that the world has been prepared for this totalitarian takeover of control of all of humanity, because it's happening in multiple fronts. This podcast was about the economic front. Until next week, you guys, I hope this helps. Refer this podcast out to your friends, like it, subscribe, and let's get these numbers up, because it's a lot of work for me to do this. And I need to know that you appreciate it, because what am I doing it for? Otherwise, if it's not to help you, help your fellow neighbor, help the fellow American. Thank you guys so much. Take care, and we'll see you next week.